Ayan. So, na-record naman siya kanina, no? Ayan nga, yung coupon payment, ayan siya. Yan yung fixed number of dollars of interest na binabayaran ng isang corporation na nag-issue ng bonds. So, for example, itong corporation na to, yung dinrawing natin kanina, nag-issue siya ng bonds kay Corporation B na lang. Okay, so mag-drawing ulit tayo dito ng building, kaya lang tagilid siya. Ayan. Ito naman si Corp B. Okay, so halimbawa si Corporation B yung bumili ng bonds ni Corp A. So yung bonds, ayan yung bond, binili ni Corporation B. Siyempre magbabayad si Corporation B dito, no, kay Corporation A. Okay, so ngayon every year babayaran ni Corporation A yung bond na in-issue niya kay Corporation B. Okay, so every year magbabayad siya dito kay Corporation B. Okay, ayan, so yung tawag dyan sa bayad na yan, yan yung coupon payment. Okay, basahin natin ulit, no? Allied Food Products bonds require the company to pay a fixed number of dollars of interest each year. This payment, generally referred to as the coupon payment, is set at the time the bond is issued and remains in force during the bond's life. Okay. Ayan. Ayan. Most of the examples and problems throughout this text focus on bonds with fixed coupon rates. Okay, ano naman yung coupon rate na yun, o coupon interest rate? Ayan, basahin natin. When this annual coupon payment is divided by the par value, so yung coupon payment na to, pag dinivide sa par value, makukuha natin yung coupon interest rate. Okay, for example, Allied's bonds have a 1,000 par value. Okay, so for example, yung bond na to ay 1,000 par value. Then yung coupon payment ay 100. Okay, so para makuha natin yung coupon interest rate, divide lang natin yan. Okay, so yan. The bond's coupon payment is 100, so its coupon interest rate is $100 divided by 1,000, or 10%. In this regard, the 100 is the annual income that an investor receives when he or she invests in the bond. Okay, so madali lang naman intindihan, no? Yung 100,000 ay $100 na to, yan yung interest, no, na binabayad ni Corporation A kay Corporation B. So sa part ni Corporation B, yan yung income niya from his investment. Okay, and yung rate nga niyan makukuha natin by dividing the coupon payment from the par value of the bond. Okay, 10%. Okay. Ayan. So, ayan. Allied's bonds are fixed rate bonds. Okay, bonds whose interest rate is fixed for their entire life, because the coupon rate is fixed for the life of the bond. In some cases, however, a bond's coupon payment is allowed to vary over time. Anong tawag doon kapag nagva-vary over time? Floating rate bonds. Okay. Yan. The coupon rate is set for an initial period, often 6 months, after which it is adjusted every 6 months based on some open market rate. Okay, so dito nagbigay lang na example, no? Ayan. Some bonds pay no coupons at all, but are offered at a discount below their par values and hence provide capital appreciation rather than interest income. So yung ibang bonds daw, wala silang coupon payment every year, no? Pero nai-issue sila at a discount. Okay? And sa part ng investor, ang magiging kita niya dyan is yung capital appreciation na instead of this interest. Okay? Ang tawag naman dyan, zero coupon bonds. Okay. Tapos ito pa, other bonds pay some coupon interest but not enough to induce investors to buy them at par. Okay. In general, any bond originally offered at a price significantly below its par value is called an original issue discount bond. Okay. So ito, familiarize mo na lang yung sarili mo dyan. OID, any bond originally offered at a price below its par value. Discount. Okay. Ayan. Tapos ito, may video ulit tayo, no? Para sa fixed rate versus floating rate. Play lang natin yan.
Fixed rate versus floating rate. First off, take a look at fixed rate. Well, what does that mean? Fixed. Well, it's not like it's a fixed card game, right? Where it's a crooked card game. No. It has more to do with interest rate risk. So with a fixed rate financial instrument, what happens is the interest rate on that instrument does not change over the life of the instrument. Now think about it. Borrowers might really like this because they will know what their interest expense is going to be over the life of that financial instrument. So what's going to happen if interest rates may fall, and if the borrower can repay this debt early, maybe it's a callable bond, or maybe it's a mortgage with no prepayment penalty, okay, then they'll just pay the thing off early. So that fixed rate might be very beneficial for them. Now, lenders might also like these fixed rates because they also are going to know how much they're going to get in return period after period after period, so long as the debt isn't repaid early. Now compare that to a floating rate, right? With a floating rate, the borrower might like these if they think interest rates are going to fall in the future, because as those interest rates fall, their interest expense will then decline. No need to go out and call that instrument in or pay it off early, right? The floating rates might also be desirable to lenders if they think interest rates are going to increase in the future, because with that floating interest rate, that means their interest income is going to be increasing in the future. So floating rate, the interest rate can change as market interest rates change, where with fixed rate, what happens is the interest rate on that financial instrument does not change over the life of the instrument.
Okay. So ayan, no. Clear naman yung ano niya, no, yung pag-differentiate niya ng fixed at ng floating rate. Pero ang ginamit niya kasing term dito is borrower and lender. Okay, so gawin lang natin dito, yung nag-issue ng bond siya yung nag-borrow. Okay, so borrower si Corporation A. Tapos lender naman ito si Corporation B. Okay, nakita mo naman yung flow ng cash o ng dollars papunta kay borrower. Okay. Ayan. And then yung instrument is yung bonds nga. Okay. Debt instrument. Okay. Ayan. Tapos, isa pang video dito, coupon rate versus market interest rate. Play lang din natin.
Coupon rate versus market interest rate. Coupons are a great way to save some cash at the grocery store, if you don't mind ticking off all the people waiting behind you in line. But in finance, this concept is all about bonds and their prices. Remember that bonds are basically loans, so they usually make regular interest payments to the bondholders. The percentage rate of those payments is called the coupon rate. Now, when you're looking at fixed rate bonds, the thing to keep in mind is that this coupon rate never changes. It gets set to whatever the current interest rate is on the day the bond's created, and it's set in stone for the life of the bond. But in the meantime, out in the really real world, interest rates are changing all the time. So when we're talking about what today's rate is, the rate that a new bond is going to have if it's issued today, that's the market interest rate. This goes up and down from day to day, and this has a huge effect on a bond's price. To understand why, all you've got to do is compare an existing bond's coupon rate to the current market interest rate and see which one you'd rather be earning. If you had to choose between an older bond with a 10% coupon rate and an otherwise identical brand new bond that only pays 5%, which one would you want? Obviously, you'd rather be earning 10% interest instead of just 5%, right? So you'd want to buy the older 10% bond. That means there's more demand for that older bond, and that's going to drive its price up. And the same thing happens the other way around. So let's say you're looking at the same old 10% bond, but this time the market interest rate has gone up, and you can get a brand new bond that pays 15%. In this case, you're going to pick the new bond. Nobody's going to want that smelly old 10% bond, so its price is going to have to go down to get anybody to buy it. And that's basically it. The market interest rate is changing all the time, but a fixed rate bond's coupon rate is always the same, locked in on the day it was created. So if the market rate drops below the coupon rate, it's going to drive the bond's price up. And when the market rate climbs above the coupon rate, the bond's price is going to fall. That's how a bond's price is affected by the relationship between its coupon rate and the market interest rate.
Okay. So, ayan. Coupon rate and market rate. So, dito naman tayo sa next na characteristic. Pero pause muna natin.